But we want to know, what did you think of the topic? What did you think of the speaker? How was your experience at every luncheon? These are just a couple ways we're always striving to improve your experience. I have the pleasure of introducing Mary Ludgin. She's clearly no stranger to this group. If you're a guest today, you should know that she's the Managing Director and Head of Global Research for Heitman. And I love starting off the year with Mary's presentation because it sort of grounds us in the numbers. She comes with data hot off the press. She comes with her crystal ball. And she, like I said, gets our year off to the right start. So buckle your seatbelts, because if this is your first time seeing Mary, you're in for a ride. Thanks so much.
I thought about trying to use this oversold crowd as a statement to my children about why they should listen to me. But I realized, I just remembered that I've been repeating myself for years, which is what parents do, and I tried this once before, and my daughter said, "No offense, Mom, but why would anyone want to listen to you?" So I'm honored that you haven't been talking to Chloe Donovan, my daughter. Instead, you've done whatever you've done to come here, and I'm going to be thinking this through with you, because I have to tell you, trying to speak about the U.S. economy and the direction of the capital markets and what it's going to mean for real estate, it's never easy, but this has been quite a remarkable last couple of weeks as all of us are trying to figure out why it is that lower oil prices are not translating into a better U.S. economy. China, which is not much of an export market for U.S. goods, but it has the potential to roil us. It could be the source of contagion that brings down the global economy, trying to parse through the sketchy data that come out of China. Anyway, I've been doing that for the last week, putting my slides together, and I'm going to think it through with you. Please put it that way, because no one knows. I've been accused of being often wrong, never in doubt. Well, I'm in some doubt at this point, because it's just so complicated. But I have put my slides together, and I did get to that lovely moment where the slide deck is done, and it's time to turn to Google Images to find the metaphor for the talk. So as I started piecing through, this is something I do myself, I was trying to look through Google Images to find the picture that would help depict where we are from a real estate pricing perspective. I wanted something that was, as my talk title shows, above the tree line. I wanted to show we're in thin air, but I specifically didn't want an Everest-like peak where the only direction we could go would be down, because that is not what I think is about to happen. I don't think the U.S. is going into recession anytime soon. There are multiple indicators of recession that people track. And one of my favorite reads is a woman named Nancy Lazar from Cornerstone Advisors, and she has 13 indicators she tracks. Only one of them is blinking warning, and that's the high yield bond spread relative to treasuries. And that's largely related to what's happening in energy and mining and steel and paper. And they are not the drivers of the U.S. economy. So I'm not seeing signs that recession is coming. Nonetheless, trying to look ahead to when it will, because we all know that it will come. So I don't think that we are at a peak. I think here's my metaphor, I think there's a potential for us to go higher. But it's definitely thin air, and we've got to be cautious and careful and prudent and apply everything we learned in past cycles to this point, in this curious point in this cycle. So with that, let's dig in. I'm sorry to have started with words because not all of those are going to be visible to people in the back. Maybe they're not even visible to me, actually. But I will make my slides available. Corey will put them somewhere such that you're welcome to have them. And so here's, if you could read this, here's what it would say. Real estate's at a high, but it's positioned to stay there for a while. Sort of like 2006. We have a couple years more to run. We're running late in the economic cycle from a technical perspective. By this moment, in most post-World War II recessions, the expansion had ended and we were going back toward recession. I don't believe that's what's underway now, but all of us need to be vigilant for the flashing signs of recession, which will come when things like 4% household income growth is happening as opposed to the roughly 2% we're experiencing today. Another sign of it will be mortgage defaults. both residential and non-residential loan defaults. We're not seeing that today. So I don't think recession is at hand, but we need to be vigilant because economic cycles do not continue growing forever. The truth of, as well, I said this, I found myself saying this stupid phrase once, the world has gotten increasingly global. Help me with this. Maybe there's a better way to say it, but the reality is that the economy of the globe is more interconnected than at any time in our life. And that means that there's a risk of contagion from things that happen in faraway places that didn't exist even 30 years ago. We've watched some periods of contagion. It looks as though the US is standing relatively tall in an environment in which the drivers of global growth over the last 15 years, I said drivers, I really should have just said driver. The driver of global growth over the past 15 years has been China. And China's in the midst of a transition that doesn't from the outside appear to be going so well. It's a difficult thing to go from their prior economic model, which was very high savings because there's no social safety net in China, and very low expenditures, and to try to shift the psyche of people into a period of higher consumption, helped by higher wages, but that transition is difficult. And doing it in a global environment in which the world is watching the change in the Shanghai Composite Index and selling against it, and the currency is now unhinged. Anyway, it's quite a time. Will it take the US down? It shouldn't. But we've got to be open to the risk of that. The US is a domestic-driven economy, and we're big enough for that to work. And thus far, while it hasn't been a fast recovery or expansion, it's been enough to make most of us in relatively good shape. And that appears to be positioned to continue, but I would say there's risk out there. Closer to home, from a real estate perspective, U.S. real estate performance has been really good, and I'll show you a chart on this in a few minutes because it's important to deconstruct why it is that real estate performance has been so good. It's largely been driven by cap rate compression, but there definitely has been significant net operating income growth. Construction remains moderate for a bunch of reasons, one of which is the regulatory environment for banks that is causing them to certainly do less from the risky end of the spectrum. There are sources of private capital that are willing to fill that void, but they do it at a very high cost. And for that reason, I gave a preview of this talk to the ULI Advisory Committee. Cindy, am I right about that? And Rich Hansen said to me, I can't find non-recourse funding. And I said, on the one hand, Rich, I'm really sorry because you're a talented developer. On the other hand, I'm really happy because we're real estate investors, and when developers have too much money, it typically means bad things for real estate as a whole after a couple of good years. So it's not a terrible thing that we haven't been able to build so much, although I understand that for a lot of you, your perspective is not going to be the same as mine as an institutional investment representative. The name of my talk is that real estate's above the tree line, and what I'm referencing here is the fact that yields for real estate are at historical lows, never before. My data source is the NCREIF index. It's only been around since 1978. It's a little like calling the World Series, right? There's some inherent hubris in that. But how about this? In our adult lives, and for some people in all of our lives, real estate has never been more richly priced than it is today. Where can you go from there? Well, it depends upon the direction of the economy. It depends on the direction of the globe's economy. More about that in a minute. And in fact, maybe I'll just get ahead and into the numbers. So thus far, job growth is strong. We added more than 2.5 billion jobs in the, billions. We gained more than 2.5 billion jobs in the course of 2015, and we ended the year with particularly strong job creation in December. So 2014 and 2015, the two strongest years of job creation over the past 15 years. We all know, those of you that hired people in December, the process that led to that probably started 12 months prior, maybe 6 months prior. So job creation is a lagging indicator, but it's a meaningful lagging indicator that has shown that at least business confidence was relatively strong 6 months ago. Now here's my favorite of all my slides, or maybe it's close to my favorite. What I'm showing you here is GDP growth in blue back to some date in the past, which is 1990. It's plotted against the total return for unleveraged real estate. This is the NCREIF Property Index. It's a proxy for core investment returns. And the format of the chart is to show you periods of recession. So here's the deep recession of 1990-91, during which real estate didn't do so well. Total return was down about 35% over a long stretch of time as we all figured out what to do in an environment. How do you mark your properties from an appraisal perspective when there are no comparable sales? That took us a long time to figure out. We were much quicker in the tech bust recession in writing down properties. But look at this, real estate returns didn't go negative during that period, which is helpful because they were so negative in the two bookend recessions, the 1991 one and the global financial crisis. That means as I talk to my clients, maybe there's a value to diversification because the tech bust downturn had some pretty concentrated geography to it. And so it's part of the argument for why maybe next time will be, certainly we hope, different from this. The other dynamic is that what has driven the recovery and the very strong performance of real estate in a period where GDP growth has lagged historical strong GDP growth, nonetheless, real estate returns for core real estate net of leverage have been greater than 12% for the past 5 years. What's driven that? Well, it's all about cap rates. Yes, there's been some nice NOI growth, but that's the cherry on the top of the sundae. What's driven it is that cap rates peaked in the second quarter of 2010 at, let's call it 6.5%, and they're off that by 175 basis points since then. And that's what's jet fueled these returns. That has gone along with quantitative easing. That's brought the cost of the benchmark for real estate, the 10-year treasury yield, that's brought it down to significantly low levels. 10-year treasuries average something like 6% for a 40-year period. They've been in the 2% range for the last year. And so real estate priced off of that, it's not absurd that real estate cap rates are in the high 4s at this point. Transaction volume, it wasn't looking so good in the third and fourth quarters. The first 2 quarters of last year were the big quarters compared to their predecessors the prior year, but the fourth quarter saw some major portfolio trades. And so we're showing you the fullness of this data series. Wasn't that regal? I'm showing you the fullness of this data series, which dates back to 2001. Clearly, the prior peak was the run-up to the global financial crisis. Well, we matched it in 2015. As real estate has commanded the interest of domestic, both retail investors and institutional investors, and increasing numbers of offshore investors. I'll get back to that in a moment. What is 2016 like? Who knows? We're going to watch January really closely, but January isn't historically a big month. We'll watch the first quarter closely, but it's not typically a big quarter. But we're all trying to gauge whether investment sentiment toward real estate remains as strong as it has been. I anticipate it will, even though some pension plan or institutional investors, the denominator has changed. How large their plans are has been hit by the stock market downturn. They have most of their assets typically in stocks, and that may mean that some of my clients that thought they had a lot of money to invest in real estate in 2016 have a lot less. But we're going to see how that all shakes out, as many allocations to real estate have been increased in an era of low yields and total returns for other types of investments. One important point I say to my clients to include domestic pension plans as well as global sovereign wealth funds and pension plans. I say to them, you're not buying a country, you're buying an individual asset in an individual market. And therefore it's important to note that while US economic growth has disappointed, there have been some quite remarkable growth stories, and I'm trying to show you those here. This is the change in total employment over the past 2 years. And you're seeing the numbers are presented, what's on this axis is in percent change. but knowing all of you are potentially skeptics, you're people that work with numbers, you understand you can have high percent changes on low basis. So I'm also showing you the aggregate number of jobs created. So here you've got San Jose, which among other tech markets has dominated the job growth over the past 2 years. It's seeing total percentage change over the past 2 years of about 9.5%, 86,000 more people in the San Jose metro area that need homes, they need apartments to rent, they need retail properties, and they need fitness and other workout things. Las Vegas has been a turnaround story in recent years after a dreadful downturn in the housing bust. Charlotte, grabbing financial services jobs from New York City, as groups like TIAA, CREF still have a headquarters in New York City, but they've gone to a less expensive but fertile ground in Charlotte. What's interesting to me is that the leaders here in looking at this over the last couple of years have been largely tech economies, and for a long while tech and energy economies, but now it's a more diversified group of economies. Houston remains in this cluster, but its jobs have come way down. At one point it added about 500,000 jobs off of its pre-recession peak. Some losses in energy have brought that down, still looking relatively healthy with a 2% rate of growth over the past 2 years. Where's Chicago in that? We've added about 150,000 jobs over the past 2 years. Sadly for Chicago, we have not yet eclipsed our pre-global financial crisis peak employment. Most of the rest of the US has done that, and Chicago has lagged behind for an array of reasons. All right, tallest midget is not politically correct, so I cast about looking for ways to talk about the US in a global context, and I came up with my saplings. And it's the truth that the emerging markets, you remember the BRICS, they were the drivers of the global economy until recently. And old, mature economies like the US and Europe were to some extent not where the action was. But that's changed in the aftermath of the global financial crisis. It's particularly changed as China's demand for commodities has fallen off sharply. And with that, the futures of places like Brazil, Russia, with this commodity orientation to their economies. And instead, who's driving global growth? Well, it's the US, it's the UK, Japan in good quarters, and other developed economies. And that has brought significant capital to our shores looking for real estate. And that we've seen that happen in Chicago, as Chicago is now increasingly on the buy list for non-US capital sources. What I'm showing you on this chart relates specifically to offshore capital investments in the United States. This is looking back, this is real capital analytics data looking back to 2001. You can see that in the pre-global financial crisis period, non-US investors represented about 8% of total transactions. Over the last 4 or 5 years, they've gone all the way up to 10.5% on average, and in 2015 alone, the total was closer to 14%. And this underestimates the amount of non-US capital coming to buy US real estate, because it captures only those transactions where it's clear who the buyer is. We buy on behalf of lots of entities that are trying to minimize the tax impact of investing in the US. We put them into partnerships where they're 49% or less of the total, and the name on that partnership is not going to indicate who they are. Sometimes there's chatter about who the buyer is, and so it will come out that it's Norges or the government of Singapore. But most times this is not known widely, not known to the real capital analytics people. So those investments are not in this total, nor is the investment in REITs that comes from offshore or the investment in commingled funds. So this is just one source, probably indicative of the trend, and it's showing significant offshore interest in US real estate. How long will that last? One can only hope that it lasts through and into the next recession, and that there's capital that will help buy as the knife is still falling. As often happens in the stock market, where people buy when stock prices are down because they see it as a buying opportunity, real estate, I think, increasingly is viewed as there's certain things that you really only buy when recession has diminished the price of something. New York City office, for instance, I don't want to buy it at the peak, but I'd be happy to buy certain locations of it after repricing has happened. Okay, so this is a complex slide, the point of which is real estate fairly priced? With yields that are the lowest they've been in our lifetimes, should we buy? Or is it time to sit on the sidelines? And this is the question that my clients are asking all the time. The typical way to look at whether real estate is cheap or expensive is to compare the yield of real estate to the 10-year treasury. But the 10-year treasury is increasingly not an indicator of how the U.S. is viewed from a risk perspective, because there's so much global capital that floats into it when there's risk elsewhere. And therefore, maybe it's better to not just look at the 10-year treasury. Maybe we should look at other indicators of how other financial assets are being priced, and that's the point of this complex chart. I won't take you through everything, but we've looked at the spread between 10-year treasuries and, 10-year real estate yields, indicated by NCREIF, and the 10-year treasury, and that's clustered in the left. We've looked at real estate yields compared to 10-year TIPS, the inflation-protected bonds. We've looked at it relative to the cost of real estate debt, to corporate high-quality bonds, as well as high-yield bonds, and relative to the implied cap rate for REITs. And we've done it, the clusters here are the leftmost is the current spread, which, can I read that? 292 basis point spread, where the yield for real estate is 292 basis points above the 10-year treasury yield. This is the average across Q4. That compares then to where we were over the past 25 years. Look at these skinny spreads. That was the spread in the run-up to the global financial crisis, when real estate was being priced as if there was no risk whatsoever. And then this is in the run-up to the tech bust. So by this measure, if you look at these various clusters, real estate's current spread looks either better or close to its long-term average across each of these clusters, with the only exception, the only blinking caution light is coming in that high-yield bond comparison. And as I mentioned earlier, because I couldn't help myself, that seems as though the bond yields there have spiked for energy, mining, steel, and paper companies. I'm not sure they're indicative of the direction of the U.S. economy as a whole, and so therefore I am tempted to say real estate, for as rich as the pricing is, real estate remains fairly priced. What will happen? Oh, another of these really great slides that you can enjoy in your spare time. But here, the point of this is, what will happen to the pricing for real estate, specifically the yield on which real estate trades, as interest rates rise? We know the Fed made its first move in December. We know that there were going to be 4 interest rate hikes in the course of 2016. Odds are now that it's more like 2. What will that mean for how real estate is priced? What we've done is to look back at the 8 periods that have occurred since the late 70s, for which we have data, and we can compare the yield for real estate and how it behaved in those few 8 periods only during which interest rates rose. The punchline here is that what happens to real estate pricing is really dependent upon why interest rates are rising. Because only in 2 of those 8 periods where interest rates rose did real estate yields rise at the same time. In the other 6 periods, they were either flat or interest rates rose and real estate yields fell. Why does that happen? It happens because people think that real estate's got potential to run, that it's got potential for net operating income growth, or cap rates are going to compress because there's more capital going in. So if indeed the world considers us to be a safe haven, that could help hold yields stable. Or if there's more money than there is real estate, that could actually push yields down, even as the macro US interest rates rise. Will that persist forever? Absolutely not. Do I tell my clients they cannot expect core real estate to deliver 13.3% one-year returns, which is what they did in the fourth quarter? No way. That's about cap rate compression. At some point, things will go the other way. It's a question of when that happens, and my bet would be to put that real estate cap rates will either keep compressing or they'll stay flat until evidence of a recession hits. And with that, real estate will get priced as it has historically. And it's just a question of investor sentiment as to how high up yields go. One of the really important dynamics, and I alluded to this a little bit earlier, is there has not been a lot of construction in the last 7 or 8 years. The format of this chart shows you the last 25 years of real estate construction. We've aggregated together construction in apartments, office, industrial, and retail. And we've looked at, in this dotted line, the average annual expansions of supply total 1.6% over this 25-year period. You can see there were periods during which we were building more. This is in the run-up to the tech bust. And lots of periods where we were doing much lower levels of new supply. And that's particularly the case over the period since 2009, when every property type until the last year has basically seen lower levels of deliveries than the 25-year average. Here's the call out at the bottom. This is retail. What I'm showing you is millions of square feet of new retail shopping center space delivered in 2014 and 2015 versus the 25-year average. Sorry, is it 20 or 25? I need to wear my glasses out in public. Very sad statement. So those of you close by, you can help me. We'll have a call and response deal happening. Industrial, over the last 2 years, more industrial than the 25-year average. Maybe warranted by shifts in how we spend, where we spend, and how much goods need to be held on store shelves versus in warehouses. And office, it remains a laggard for lots of good reasons, but this is going to be an investment opportunity long term. It's just not an investment opportunity I would suggest you start tomorrow, given how close we are to the end of the economic cycle. And then apartments, here over the last year, more apartments delivered than has been the average for the last 20 years. This is a census data. This is a census number, so it includes the big version of multifamily. So included in that are condos, senior housing, student housing, anything basically 5+ units or more. So that skews it a little bit, but no doubt. The best performing property type, the first recovery property type, has seen the most construction. Here, my favorite, or my second favorite chart of the whole deck, is this net operating income growth chart, because it lets you see how different property types here, retail, office, apartment, and industrial, how they perform at different points in the cycle. And the conclusion here to this chart that begins in 2002 is real estate, broadly speaking, is performing well at the fundamentals perspective, led by apartments where even with the highest level of new supply in the last 15 years, we're seeing apartment rent growth, net operating income, so the function of occupancy and rents, it's still growing at remarkably rapid levels, especially relative to long-term averages where apartment NOI is expanded by a 4.5% rate of growth. We're well above that. And that's the case for each of the other property types, with a little bouncing around depending on the property type. So real estate fundamentals at the national level are in great shape. There's a little variability by property type, and I'm going to spend 5 minutes on this, and I'm going to jump ahead to my conclusion, which is, broadly speaking, real estate's in great shape. The closest to a peak comes in the multifamily sector, where here you're seeing supply and demand. We have more demand than supply in the year 2015, and occupancies are still rising, but that will change. There's enough new construction now. This is quarterly construction of institutional quality apartments. Deliveries have been significant enough that we're expecting, along with Axiometrics, the source of the effective rent growth forecast, that our rate of rent growth for apartments has peaked. It's going to slow. Will it slow as far as this, which is a little under 3%? It could happen. In Chicago, what are we seeing? We're seeing suburban strength. relative to CBD weakness. If you could read this chart, which you can at your leisure, you would see Chicago shows up here, 2.5% year-over-year rent growth in November. That compares with really rapid rent growth in some coastal markets, Portland, Oakland, and Sacramento, if you can call Sacramento coastal. They have almost double-digit or double-digit rent growth right now. And in fact, it's the case that in this top 35 markets, only one, Virginia Beach, is seeing rents go negative. The Chicago story is one of lots of new supply, less of it in the suburbs, and that shows up in the rate of rents, which are running at 3.5%, 4%, 5%, depending upon the submarket. Downtown Chicago, River North, Gold Coast, the scene of a lot of deliveries. 5,000 deliveries happened in the downtown last year and the year before. That has brought rents to a standstill. And there's new supply coming, more supply than we've seen to date. Long run, it'll all work out. Downtown Chicago's grabbing market share from the suburbs from a job perspective. Millennials want to live near amenities. That means they're not spending their money on car payments. They're spending it on divvy passes and walking to their jobs. And that has supported the downtown apartments despite significant construction. But a good performance brings a lot more investment, and so we're likely going to see some very soft apartment rents for the next year or two. Long term, it'll be fine. Short term, underperformance in apartments. The industrial story is one of significant demand coming from e-commerce related tenants, be they pure play internet retailers, and there are fewer and fewer of those, more likely omni-channel retailers who are needing to get goods to people. This was Keith Lord's presentation. Hello, Keith. You did a great presentation at Realty Club. I will steal some of your thoughts because they're good ones. He said, I think, I'll quote you on this, that retail used to be about bringing people to goods. Now it's about bringing goods to people. Well, that's why you're having significant warehouse demand that relates to retailers that are trying to get goods to you quickly to keep you clicking and buying. Broadly speaking, the U.S. industrial market's in very healthy condition with strong net absorption. We're particularly fond of seeing that the strongest rate of rent growth is happening in the 10 largest markets. They're shown here in red, and in particular within the e-commerce corridor like I-70, formerly sleepy markets like Indianapolis, Columbus, Memphis, and Cincinnati seeing very strong rent growth as they are within a day's truck drive of 60% of the U.S. population. The point of this chart is that while there's significant supply of new warehouse space under construction, it's in line with recent demand. Will that change once the recession hits? For sure, but for the moment, it looks as though you've got at least another good year ahead in warehouses and warehouse rents. Office, the important news here is that offices are getting healthier. The vacancy rate nationally now at 13.2%. These are metro statistics. And the rate of improvement has finally started to accelerate. And that relates to we're through the downsizing and the right sizing that were the outgrowth of the global financial crisis, as well as innovations like the open plan. Increasingly, when leases expire, tenants are taking more space rather than less. And our stock is old, and that will create some development opportunities, most of them in central business districts. The point of this chart is that we're seeing faster rates of job growth at the metro level and the national level in the office-oriented sectors. That bodes well for demand for office space going forward. And there's modest levels of office space under construction. We just ticked back up over the 2000s average, but only expanding supply at a rate of 2% of inventory. Nothing to worry about. I'm going to skip through that. Rent growth, some places like San Francisco and other tech markets still seeing very strong rent growth. Chicago in the more modest reaches. This is a metro stat. Downtown rents much faster growth, but metro at 2.9% year over year. The retail sector, I don't have enough time to do justice to it, but let's just say that I've entitled this slide, Bifurcation of the Retail Market Continues. In many ways, this is about trifurcation. The point in retail is that the strongest of the centers, they weakened in the global financial crisis. So this is the vacancy rate pre-GFC and into the GFC for the healthiest of centers. So their vacancy, they weren't immune to store loss. But what's happened from there is the vacancy for the highest quality centers is now well lower than it was back in 2006. Similar dynamics for the next tier of centers, but for the weakest centers, vacancy has come down only modestly. The C quality centers, be they open air centers or regional malls, they have a future in some other land use. They will be self-storage, they will be senior housing, they will be something else as we continue to purge old, badly located retail. In the meanwhile, the highest quality retail centers, even in this era that Keith portrayed to you quite appropriately, of tumult in how we shop, what we buy, where we buy it, how we buy it, the strongest retail centers, be they open air or regional malls, they remain strong, and they will continue to be strong as we seek experiences in what we do with our time. We may be clicking for apparel at home, but we're going to go bowling once we've made all that clicking, and we're going to want to see one another. And that's the point of the strongest centers, but the other retail centers are at risk. Let me jump ahead. It would be inappropriate of me not to mention self-storage just because it's such a find. This is a sector that the point of this chart is the rate of revenue growth over the last 4 years exceeding 6.5% for the major REITs, public REITs in the self-storage space. It's a sector I'm happy to talk about in the Q&A because it's really fascinating. This level of revenue growth in any other sector would have prompted immense amounts of new supply. Those of you that run cities, you don't like self-storage so much, so you say no to it, which means, oh, what a great investment. I'm going to conclude with a couple of investment strategy ideas for you. So tick, tick, tick. We are late in the economic cycle. There will be a recession at some point during the development of an asset if you're just starting today, or at some point in a 5 to 10 year hold. Real estate property types behave differently. Some of them are going to see the effects of recession immediately. Self-storage will see a 500 basis point loss in occupancy almost immediately as people like me say, what's in the storage locker and why am I paying $200 a month for it? Okay, so that happens. In apartments, you see quick response to recession. People decide they really don't need to spend $3,500 on a 2-bedroom apartment. They can get a roommate or they can get by with less. So those are sectors that see an immediate impact. It's a slower impact for industrial, office, and retail, but we still like the short lease term sectors because they recover quickly. So we're still buying those. We just know that they're going to see some short-term hit. There's been modest levels of construction across property types, and that creates a bunch of investment strategies in finding quirky offices with the kind of charm that's going to attract the creative class, among other things. That quote in the upper left, you were expecting me to quote Wayne Gretzky, and I will. My point here is the demographic drivers. What did Gretzky say when he was asked why he was so good? You all know. You can say it with me, come on. I don't skate to where the puck is, I skate to where the puck is going. Well, demographics tell us where things are going. So in times of stress like this, we can look at demographic trends like the aging of my generation, the boomers. We never thought we'd get old, and we're going to go at it differently than our parents, that's for sure, or maybe not. We can look at the millennials and what they think they're going to do, and we can predict how much of that is really going to come to pass, given what we know as people that also thought we would live downtown forever, but then ended up in the suburbs. So demographic trends are out there to pluck and to try to mine for investment opportunities. And then finally, here's my chicken. I was once accused by somebody of suggesting they were a chicken. No, it's about diversification. Do not put all your eggs in one basket. I use that to talk to my clients about the value of being exposed to multiple different types of economies. My thesis is that the last recession we led through was the widest of our lifetimes. It was 49 out of 50 states. Not likely that same dynamic will happen in this recession. The last one started as a housing downturn, and those tend to have the widest footprint. This one would likely be, what do you want to nominate as the sector that's going to go bad? Tech. I don't know how, I don't know why, but I would put my money on it being tech that explodes first. The geography of tech is not just concentrated on the coast. There's certainly tech exposure in places like Chicago and Austin and Nashville, but diversify your portfolio because it could be a more concentrated downturn, and that could mean some metro areas escape it completely, and that would help their real estate performance. So sorry for running so long. I hope this has been helpful as you're thinking through a tumultuous time. And do we have time for a couple questions?
Yep, Chad's got the mic, so.
Yes, I do.
Mine's the one that
Right.
Hi, Mary. Great talk.
Thank you.
Mary, I understand the pricing and the cap rate compression, but what I don't understand is the exit caps. People are holding things for 7 years, 10 years, 5, whatever. Are they looking and thinking NOI growth is going to offset the likelihood that interest rates are going to push up cap rates in the future? Or how's that thought process going?
They think there will be some of that, but broadly speaking, they're saying to themselves, we're not going to be selling these assets. It'll be older. We're not going to be selling them at today's cap rates. We're going to be selling them at 50 to 100 basis points over where they are today. Is that enough? Probably not, but it's the convention of the time. And so that's the premise, 50 to 100 basis point higher exit cap than going in caps.
Hi, Mary. Good presentation.
Thank you.
Any thoughts about the hospitality industry, both here in Chicago that's seen a lot of run-up in new construction and openings, but also nationally?
Yes, so I don't talk about hotels because I only stay in them. I don't typically invest in them, but I can tell you a little bit of the perspective from the outside. The hospitality industry has done a great job in helping to reduce the oversupply of C office space in central business districts. It's not a laugh line, it's a marvelous dynamic that's brought back to life some wonderful buildings that had diminishing tenancy. With that, plus ground-up new construction elsewhere, it looks as though we might all be well-served from a hospitality perspective. So it's my understanding that there's been some prediction that yields for hospitality might actually go up in 2016, as there's an assumption that RevPAR might have reached its highest levels. But I say that only repeating what others have written. It's not what I'm living myself, where it seems as though my hotel cost always exceeds my airfare, and it seems to always be more than it was the prior year. But I've now told you the whole sum of what I know about hotels. Ask me a question I know the answer to. That's a challenge.
Mary?
Ruth.
Are corporate inversions, like the Tyco, Johnson Control, are those any indicators of something other than just a tax ploy? Do they tell us something about our economy?
Oh no, that's a thoughtful question. So the fun question, and I don't know that I know the answer to this, Ruth, but the fun question would be to see, when did those corporate issues come? I presume they happen later in a cycle. And therefore, are they predictors that we're late in the cycle and therefore it's about to end? I think they probably are. Are we seeing such things right now? I'm not reading much about that. Are you asking this because you're seeing rising incidents? Oh, I asked you for a question I knew the answer to. I don't know that I have an astute observation to that. I guess I would just say we're a mature economy, and the cycle is long in the tooth, which makes it harder to get good income growth. Maybe this is the moment where more shadier things happen. But I'm a little... I'm going to stop talking.
Moving on.
Thank you. Thanks. Yes, please.
Mary, you closed your presentation with, you dropped this thing about the tech sector. And
I did, didn't
yeah, I know.
I?
So I'm sitting here thinking, both my children work in that sector. And I don't want them moving back home because that would cause me to have to refinance my house and then have another
We
crisis.
would be happy to rent you an apartment.
So, So last time it was driven by mortgages, essentially, the last
Yeah.
recession, which in my simple way of thinking is bricks and mortar and lots of houses that were vacant and lots of developments that were. Why, when I think of the tech sector, I think more of intellectual property, even though I know there's machinery involved in it and so on. Why do you think that would be like leading or a big problematic situation for the next bus?
Well, here's how it would be problematic. Well, first you've got the tech valuation question. So the private companies, the private tech companies, as they come public, have not matched the valuation that they seem to be expecting. So there is that. There's the stretching of valuations that may not indicate that the sector is going down as a whole, but maybe there's been some froth in how it's being valued. And where it hits real estate is in the amount of expansion space that tech companies are taking in certain very tight office markets. Seattle, San Francisco among them, where there are empty floors that are being taken by tech tenants in the anticipation of growth into that. That's ringing bells from the last go round when that dynamic was happening nationally. If it continues and our office markets remain tight or continue to tighten, there's a risk in places outside the traditional tech locations as well. I don't see screaming signs that tech is overvalued at this point, but if I had to nominate a single sector, that would be the one I would nominate. So take it for what it is. We know there'll be some trigger, we just don't know what it is, and the overvalued part of tech is what's causing me to call it out.
Mary, you briefly mentioned the millennial impact on real estate.
Yeah.
I know that's everyone's favorite generation. I'm a Gen Xer.
So it's not your favorite, right?
What about my generation's impact on real estate?
Well, you are the smallest generation in recent history, and you're the well-trained, generation that is now in its rising authority and power stage. So will you lord it over the annoying boomers and the annoying millennials? And what will that look like? That's hard to know.
I think you have.
Yeah, he's looking rather lordly. Yeah, sorry to say, you're very small relative to the behemoths on the other side. We survived as an industry the period during which there weren't so many of you, and we were worried about what would be the demand for apartments. Nonetheless, apartment occupancy was really good, but we're thrilled we survived that period.
So we can blame the boomers.
Go for it. There is so much to blame.
Hi, Mary.
What do we do now?
I have a question for
Mary.
you. Hello. Financing. You talked about high yield spreads and whether or not that's relevant, but what about financing for real estate in and of itself? There's definitely been more discipline, but have you seen financing get worse, quote unquote, over the last year or so? Spreads have increased, CMBS spreads, etc. Do you think that's a trend?
I do think it's a trend, as nervousness is a component of the era, and there have been some good aspects to that and some problematic aspects. As I mentioned, the good aspect has been less development, which is a good thing for real estate overall. The more disciplined we are as an industry, the more money that flows long-term to it, the more it's a stable property type. But for certain strategies, it's very expensive to get financing, and that means that the price of those assets could be affected by the inability of prospective investors to get financing, as just one of the simple linkages there.
And that's a new phenomenon.
It's a new phenomenon emerging over the last 3 quarters. One final question.
Final question. Do you have one for Todd?
Or we can just call it a day.
We can call it.
As always, we're happy to have Mary kick off our year with the projections. We've never really called you on Cascus, how many came true, so that's a good thing. That, we'll keep you on the and we expect to see you next year. But next month, innovation and economic development in water resources. Registration is on the website right now. You should have gotten an email as well. February 17th. Same time, same place. If any of you are having issues with registration, logging on, whatever, please talk to Corey and work through all those issues. And we'll see you next month. Thank you very much.